All right, it's Josh Rubin here with the Rubin team and my venerable Mark Chin. Mark, we have a lot to unpack here in the Insider. Today is Friday, November 11th, and in the wake of this week's record move in rates to the downside as a result of lower than expected CPI, what are we looking at?
Well, yesterday the financial markets had a hell of a run. NASDAQ was up over 7%. Dow was up 1,200 points. And as you just pointed out, the bond market also had a very nice pop. And what that means is rates go down. So we saw the single largest drop in rates in over 10 years in one day. And the 30-year fixed mortgage, the jumbo mortgage, dropped from 6 3/8 down to 6 even. And that's a trend we like to continue to see.
And of course, our friends with the conforming loans in most areas throughout the country, those are over 7, but they dropped into the 6s, and people are jubilant. And what impact that has on the broader market remains to be seen. But of course, our insider index is seeing a little bit of a move to the downside from what was clearly a buyer's market to things returning maybe to a point of equilibrium. But we're seeing contracts signed still at 378, new listings at 610. Now, what's interesting is that is down markedly from last year's 955 new listings that came on in the same corresponding week. And the 610 is down about 30+%. So that's what we're seeing overall, right? I mean, inventory is still pretty low.
That's right. And I think that we have to remember that the insider index is a ratio of price drops to contracts signed. So when it starts to drop like that, part of it just could be, less price drops. And so what we're seeing is a return to normalcy there. But again, you're absolutely right to point out the contracts signed are still lower than a year ago. Let's talk a little bit about a theme that we've been mentioning for a while now on the Insider, which is that when we're talking about the asset class of real estate, we need to be thinking about it in terms of medium to long-term hold. And the idea that you can sort of trade real estate is not usually a good idea in the long run, right? So let's take a look at the stock of two of the companies that do house flipping, that is short-term trades in real estate as a business, OfferPad and Opendoor. And what do you see, Josh?
Well, it's interesting. There's a very close correlation between both of them, and they're both down 90% year to date, and that's really because we're in an inflationary environment, and real estate is taking longer to sell, and it's costing more to carry it. So it just makes sense that both of these companies would do well in a market where real estate is going up at breakneck speeds like we've seen the last few years, and do worse in environments like we're seeing today.
I think that's exactly right. And one of the things to realize is these companies offer to buy your place for cash, usually your home, and then they fix it up. And the idea is their algorithm is smart enough to find value, and then they put it back on the market and sell it. That's a highly capital intensive business plan because they are paying cash, but on the back end, they're borrowing billions of dollars to execute this move. And when interest rates are rocketing up, their costs of doing business are soaring. Add to that the fact that these homes they're buying are worth less than what they paid for them, and it becomes a very dubious business model indeed. Let's take a look at one of the things that's going to support the market in New York City over the long term is this. Very simply, New York City does not build enough apartments, and this graph shows a trend of employment growth well over the trend of apartment growth in New York City. And this has been going on for decades and decades. I only show this graph up until like pre-COVID because the COVID numbers are crazy. But the long-term trend is very, very clear that for every job that we make here in the city, we make about 0.1 of an apartment. So that's simply not enough to support. And going forward, that trend is bound to continue.
It's an island after all, right, Mark? So we're perpetually seeing not enough supply, and that's what really supports our market.
Yes, that's true. And it's also an island with a lot of like funny quirks to it, right? We have this thing called the 421A tax abatement that was a big give back to developers. They got back 10 to 35 years of taxes, and it made building affordable housing compelling as a business plan. But 421A expired in June of this year, and as this table shows, there's been an awful lot of building of giant, very expensive homes in lieu of building lots of homes. And if this trend continues, we're going to continue to be very resource constrained. Can you tell people what this table is, Josh?
Well, what we're looking at are development sites that have been built on in the last few years, what zoning would permit in terms of unit density and what was actually developed. And so, for instance, 1165 Madison, depending on the unit mix, one could have developed or built 88 units and a height of 210 feet. And instead it wound up being 11 units. Now, that was an ultra luxury development on the corner of 86th Street, moments from Museum Mile. And it did very well. The same developer, of course, did that. And 1045 Madison, the Benson, which was also similar unit mix where they could have put in 83 units and they built 15. Again, these were apartments that were on average probably sold for about $15-16 million. So not insignificant. They were each, about 4,000 square feet. So quite large, quite luxurious. But what's interesting is these new developments, like I'm thinking of 64 University Place that hasn't been released publicly yet, being marketed by Douglas Elliman, and they have one bedrooms there that are very hard to find, as is indicated here in the chart. And all the one bedrooms are the first to sell. It's the larger penthouse units that are held back for one reason or another. So
we can't blame developers for doing the things that make them money, right? They're just playing the cards that they're given by the government and the constraints of zoning and the constraints of the tax regime and what have you. But unfortunately, for the greater good of the city, it's not very dense development that's happening right now, and this is just an example of it. I think that wraps it up for this week, unless there's anything else you'd like to conclude with, Josh.
Well, I think that covers it. One thing that we didn't talk about is the fact that negotiations seem to be happening in Ukraine with Russia's pullout. COVID is coming away from its zero COVID policy a little bit, looking for an uptick in business activity there. And of course, back home, we saw the FTX crypto exchange file for bankruptcy today. And so there are some interesting things happening, largely positive. And now that we're on the other side of the midterm elections, which I always said that we're going to have this sort of overhang before the elections. Now that those are behind us, it's no coincidence that literally a day after the elections, we saw this huge run up in the equity market. And now the skies seem to be clearing. What happens with the next Fed meeting and rate moves going forward will be interesting. But if that's all we have to worry about, I think we'll be okay.
I think that's right. I mean, the market seems to want to go higher here. If we get some concerted trend of inflation dropping, got to watch out for the stock market to rocket upwards, and that'll be very good for us.
By the way, guys, I'm coming to you with the background here. This is the living room at 682 6th Avenue, which is just between 20th and 21st. And what's unique about this space is that the retail space is owned by the co-op. And what that does is it sends the revenue from the this prime retail space up to the unit owners upstairs. So it offsets your maintenance. So you're essentially living there for free. Winds up being about $30,000 a year. But if you apply a cap rate to that, you're looking at about $500,000 conservatively in value. We're asking $2.5 million for this space. It's currently set up as a 2-bed, 2-bath. It could easily be 3 bedrooms, 2.5 baths. Also has 4 exposures, and it's bathed in light. So if you'd like to see it, definitely hit us up, josh@rubinteam.com, 212-321-7111. And look forward to seeing you soon. Mark, as always, great job, and want everybody to have a great weekend.
Have a great weekend, everybody. Take care.